I am Michael Rose, founder of Metropolitan Capital. We are what would be referred to in Europe as a universal bank. That is private banking, commercial banking, and investment banking all within a single platform. So think Goldman Sachs, Barclays, UBS, all groups with whom we work relatively closely. In Europe, universal banks exist both large and small. In the United States, frankly, in North America, they're really only large. We are, to our knowledge, the only boutique universal bank in North America. We focus upon startup companies to middle market companies and the founders and families that own or operate them. So we have a little bit of a unique perspective here. We are regulated by pretty much everybody known to man, and yet we are a differentiated lender. On our balance sheet lending, we provide lines of credit, primarily helping high net worth individuals, founders, and family offices to leverage their own balance sheet to create substitutes for mezzanine and equity. Again, I did say we're FDIC insured. On the investment banking side, we help in the advisory capacity we've helped a number of platforms to access new and what we think are very high quality sources of supply, as well as on the investment banking side, helping to raise capital either at the entity or at the asset level. Today, I'm going to focus most of my comments on the debt side. Our colleagues preceded us certainly have been doing some extraordinary things on the equity side. Many of the things that I'm going to mention probably you can make application of within the equity markets. But for today, in the arena that's had a little bit more traction to begin, at least on the debt side, that's where I'm going to focus my commentary. So let me begin. Oops. And I'm going to sort of talk about, in addition to sort of what's next in finance, maybe sort of what we hope is next or what we think should perhaps be next within alternative finance. And I'm going to start with, in the sense of the Chinese proverb, both a blessing and a curse, which is the association that we think may exist between the mortgage market and its proliferation and the alternative finance market. There was a time in what is now a highly commoditized and robustly liquid market that it was thought to be entirely too idiosyncratic to ever be any of those things. People have sometimes said the same thing about the alternative finance market. In the mortgage market, if you had said that, you would never believe that you now have $1 trillion in annual originations and one of the most robust, perhaps too robust markets in terms of exponential growth of supply and demand that has occurred since the time of the Depression. This is in part why colleagues such as Goldman Sachs, with whom we work a fair amount, have identified that for the alternative finance market, 100% of the residential mortgage market is part of the total addressable market for alternative finance. That has a lot to do with that liquidity. There are lessons there for the other sectors of finance that alternative finance is bringing to the mainstream. So next, in broader brushstrokes, if the industry were to make the same throughput in terms of liquidity that is brought to consumer, unsecured, student, and small business loans, you're not talking about $1 billion of total addressable market. You're talking about trillions of dollars. Now, obviously, that sounds a bit fanciful today. But if you had told somebody at the time of the Depression what the size and liquidity of the mortgage market would be, the residential mortgage market would be today, they would have found that even more fanciful. So, oh great, got this here. So the things that we think are most important that need to be addressed are supply and liquidity. So on the supply side, it is quality supply that needs to be augmented. There is a current shortfall of of supply to meet the oversubscription of demand that exists in the marketplace. That not only needs to be addressed in the near term, it needs to be continually augmented in the long term so that it can match what would appear to be the significant potential increases in demand that can occur over time. So second is liquidity. That is the primary way to unlock that long-term demand. The development of a robust secondary market for whole loans and securitizations. And let me make a quick statement. There has been extraordinary growth in supply in this industry over the last 4 or 5 years, the last 2 or 3 in particular. In no way do I mean to minimize the extraordinary efforts that so many people in this room have contributed to that. But relative to the size of the broader market and relative to the broader financial markets that you have now captured their attention, relatively small. And to satiate that demand, extraordinary increases need to occur. Similarly, on the liquidity side, heroic efforts by some individuals to create securitizations, to create large block whole loan sales. Great initial steps. Long way to go before the broader financial markets will consider this to be a liquid asset class and bring in the kind of demand and investment of which it would seem otherwise capable. So here are some things that are worrying us a little bit. On the supply side, we're beginning to hear from some very large historic investors that they are plateauing, that they've identified that the market is great, but it's not growing as fast as they would like to see, considering the extraordinary amounts of capital that they need to put to work. They're not pulling out, but as you know, if you're moving forward before you reverse, you first have to stop. And so this is a warning sign, I think, that the market's beginning to identify that much has been done, but in nominal terms, still haven't moved the needle, and I want to see that move faster to continue to allocate time, attention, and most importantly, capital to it. The other concern that we're hearing is that the supply that is increasing, there are concerns that it relates or is consequent of degradation in credit quality and in terms of increasing or at least not declining customer acquisition costs. They have good reason to be scared about those things because of how negative they have impacted not only flow but also the risk profile of the assets that are created in those manners within other sectors. So please understand why they come by honestly those concerns about the market. The largest concern that we have is that you don't want to see supply and demand be out of balance and have it come in demand through a diminution in demand, come into balance through a diminution in demand. What you want to see happen is that supply increases at an even faster rate than demand is increasing. So they come into balance in an appropriate and healthy way. And again, that's why we think increasing supply quickly is of paramount importance. Next is liquidity. Here's some things that are concerning us there. We see a lot of medium-sized investors that are beginning to be maxed out. They simply can't allocate any more to the asset class while it remains within the illiquid bucket. That is an area of concern. Those are early adopters. Those are people that are willing to fly the flag for you, but they're having to look at other asset classes because they're tapped out in terms of liquidity. Second thing is those larger investors. Again, it's affirmation of this perception that the market is not evolving fast enough to merit an increase in investment at this time. It's sort of a ratchet effect. The more that they allocate, presuming that they can't get out, that they have to hold it to maturity, they become concerned that every time they put more investment in, it's a ratchet. And without the ability to reallocate those assets, it diminishes the amount they're willing to put in the first instance. And finally, obviously, this causes some very large financial market investors to not get very far in approving the asset class because of that lack of liquidity. And again, the group and the industry has done such an extraordinary effort and thing in acquiring the spotlight for the financial markets. Being in the spotlight does a couple of things, right? It exposes your weaknesses, it exposes your flaws. It's an extraordinary thing to have captured it, but you have to continue to perform while you're in it because they will quickly turn to something else, and it's very hard to get the spotlight back once you've lost it. All right, so how do we address these things? So from a supply standpoint, we focus on the addition of curated, unmanipulated, proprietary flow. Let me talk about those words for just a second. So curated. Anytime human beings get involved, I know that there's a lot of tension around support as technology companies for the platform, and we focus a lot upon technology, but human beings have a very positive, highly correlated effect upon asset performance, closure rates, et cetera. The more often that people are involved, the higher those elements are. And so curated means where somebody has sort of pre-screened, if you're working with an employer or a bank or someone along those lines, where they have relationships through which they've gravitated to that group, yet they're not quite a fit for them. That's still great screening that will have very positive follow-on effects in terms of, again, closure rate and risk performance. Unmanipulated. We have a lot of friends in the brokerage community. They perform a very important role. But anytime somebody's primary source of compensation is fees associated with the funding of a loan, they're under extraordinary pressure to manipulate that borrower to look like they fit within your box for so long as it takes for that loan to fund. And so you have to be very careful with these sources. And the broader markets understand this. They get very concerned when platforms start to buy lead gen and deal flow because of that lack of curation, because of the propensity towards manipulation. And then finally, proprietary. This is relatively self-evident, more robust, should be more consistent, should ultimately have lower cost, and you're not at risk of losing all your flow over an extra basis point or two in an auction environment. The market at the entity level and at the asset level will strongly value these proprietary channels, and so we highly recommend that you make them as proprietary as possible. On the liquidity side, talked about a fair amount of these things today. Greater transparency, the Thomson Reuters, Perm ID, those sorts of market tools are essential and extraordinary steps forward. Greater standardization. Let me spend a minute on this one. Legally and regulatorily sound and scalable structures. We work with a lot of platforms. We very much understand the pressure from investors to demonstrate that you are a technology company and that you are an unregulated enterprise. We see some painfully tortured structures intending to circumvent the securities regulations or lending regulations. And frankly, we think that that is a short-sighted and will not end well path. Ultimately, if there's an issuing bank involved, the requirements of the FDIC and compliance will push their way back up to the borrower anyway. We all understand that. If at any point you're entering the securities market, you have to adhere to the guidelines that exist there. And so structures that either are not scalable because they have one registered representative and run all transactions through them, or frankly, they're scalable, but once you'll be a victim of your own success. Once someone of a regulatory body sees that you've done enough of this to be meaningful and they begin to apply scrutiny to it, it's not going to hold up. So for investors of the platforms, please have some patience with the platforms themselves. They need to embrace the coming and existing regulation. There's no reason to be afraid of it. Trust me, I speak from personal experience. We are regulated by pretty much everybody known to man. We do a lot of non-traditional things. If you work collaboratively with them, you are able to do a lot of interesting and non-traditional things. We highly, highly recommend focus upon that, because if you do that and that's all revealed later, that can just be fatal. Now when you're smaller is when you can address these issues, put in a foundational platform that is scalable, have your clients with the support of your investors, have your attorneys with the support of your investors, put those structures in place as soon as possible. Additionally, we need comprehensive data analytics and research availability. Folks like Crowdnetic obviously do an extraordinary job in bringing those to the marketplace and informing investors. And need a critical mass of market participants. Again, the group's done a great job of bringing hundreds of people into this space. We need thousands, tens of thousands to have a liquid market. Okay, so in terms of finding partners, here's some things that we a governing law that we try and keep in mind. An intermediary, in terms of its survival, must continue to add greater apparent and actual value to a transaction or market than they extract from it, or face eventual disintermediation. That is we've found to be pretty evident in most economic cycles, and it's certainly true here. I think a lot of people think that banks are the most likely target for disintermediation, and certainly aspects of their business are. But I would ask you to think back to the mortgage market. I mean, at one point, every mortgage loan was originated, funded, and portfolioed by a bank. That is certainly not the case anymore. Banks still exist. They evolved. The mortgage market participants evolved with them to leverage what they had to bring to the table, which frankly they brought willingly, which was client acquisition and service infrastructure for sales, and numerous large balance sheets to act as purchasers of the resulting mortgages. Those capabilities still exist in the marketplace today, and the ability to partner with banks to achieve that growth and both objectives in terms of supply and liquidity can be important. And Ask not for whom the bell tolls, right? It tolls for thee. We are all intermediaries interposed between the ultimate individual investor. They may invest through a very large financial institution, but ultimately there is an individual or family at the very end of that continuum, and at the other end is the borrower. And we are all in between. And if we don't add more value than we extract from this transaction, they will find a way around us. We think that banks can be useful partners, again, in augmenting quality supply, as well as providing the critical mass of trading partners that are necessary for a liquid market. All right, so the value proposition for banks is relatively straightforward. With large banks, it's about outsourcing smaller balance deals, right? These are loans and opportunities that they would never admit this publicly, but they'd really rather not do, and are forced to in many circumstances appropriately by Community Reinvestment Act, outsource it to another party who can do that more efficiently, buy it back. It seems a little bit counterintuitive, but when you think about efficiency in the marketplace, it actually makes a fair amount of sense. It's exactly what happened in the mortgage market, right? Refer that out to somebody who can process that and originate it faster. And don't forget how that the mortgage market, just by perspective, one of the most regulated or regulatorily intense markets in the world. So with small banks, it's about add to the product and service menu. Now you compete with the larger institutions because you can offer products and services you couldn't have otherwise. All banks earn additional fee income. All banks retain the deposits. Here's the problems with partnering with banks. And it's probably more than three. But these are the most important three. And the first two are the two most important: compliance and IT integration. If you can get through the first two, then the third one becomes a problem, which is incentives at the CSR level. Just a point of perspective. So for these IT and compliance folks that you think are being completely unreasonable, their inbox was already full before the CEO brought in your shiny new strategic alliance. They already felt like they were under-resourced, okay? And here's how the value proposition works. If it does really well, their participation in that upside is about zero, okay? And if you have a compliance problem that creates a violation and puts the institution under a memorandum of understanding or worse, you get fired. If you have a data or security breach on the IT side, you get fired. So when somebody participates almost or very little in the upside benefits, but participates very strongly in the downside benefits, it's actually very rational behavior for them to be very slow and cautious about doing this. It gets exponentially more difficult with the current multilateral approach, which is trying to do one-off heterogeneous arrangements with multiple different institutions. They don't have the time, effort, and energy to do one. Doing multiple of them is pretty much a non-starter. Finally, CSR incentives, just one quick note here. If you get through the first two, which you can do, we've helped people to do it. We certainly understand this perspective because we're in that community. If you get through the first two, if you are not pushing the rewards all the way down to the person that's on the phone or sitting across the desk from your client that you want to encourage to use your service, at the end of the day, your throughput is going to be relatively modest. It doesn't have to be a lot of dollars, but it's got to find its way all the way to that touch point for the client. All right, so what can be an answer? The gateway, okay? The gateway, conceptually, a single common gate, right? A single point of, think of it as a single common language to facilitate. We've talked a lot about eliminating friction. That's really the whole idea here. To eliminate friction, create a single entry point, a single pipe that you connect to so that an individual platform can connect to this one pipe and access thousands of banks. On the other side, an individual bank can connect to that and connect with multiple platforms, a full spectrum of participants. And what this should do is eliminate some of the structural impediments that occur in terms of greater cooperation between the parties. It's what evolved over decades within the mortgage market and could happen within a year within this current time frame that we're in. So let's talk about what the potential benefits are. Standardized reporting and transparency, we've talked about how important that is. That's going to aid compliance and regulatory. We're going to make the jobs of those IT and compliance people easier instead of harder, right? And have them just do it once. So they get to be a hero by getting something out of the inbox and into the outbox faster. Robust permissioning. This still enables proprietary relationships amongst the players. So Bank A can turn off platform C, turn on platform D, and the reverse is also true. Now you can, through this more efficient infrastructure and platform, still achieve proprietary access to flow. Banks earn fee income from loans that they would not or could not have made otherwise. Platforms realize what should be lesser acquisition costs. Banks get to maintain the face-to-face relationship with clients, generate and maintain those deposits, which is key to the value proposition of aligning yourself with non-depository lenders. Parties can monitor and reward positive behaviors. As a platform, you can say, Bank A, the more referrals that you send to me, the more of the risk class of asset that you want to purchase, probably Class A or Class B, I will allocate to you. Or, even more nuanced, I can now send you or give you priority to obtain loans that are in LMI census tracts within your assessment area from a CRA standpoint and help you more quickly and profitably address your CRA obligations. And then finally, once banks are participating, once you've got this critical mass of thousands of potential trading partners and this constant flow on whole loans back and forth, now you've got the foundation upon which to build a true secondary market and add liquidity, which is exactly what happened in the mortgage market, as you then port into this gateway other institutions that and participants within the market that support it. So, what's that? And you can learn about Gateway at crowdnetic.com, as Luann has rightly pointed out to me. Okay, so I'm pretty close, but
I'm going to bring up Deborah Walton.
Wonderful.